Managed to only get one close below moving average for the entire day. And that's really impressive. Normally you get at least a couple of closes below moving average. So obviously that is a sign of strong buying by the bulls. Let me go ahead and turn the question box on. All right, so overall on the daily chart, you can see we formed a strong reversal up on the August 1st low. And we reversed up ever since, and we were in a tight bull channel for the bulls, retesting the July high. Then we broke above it today. Really no surprise. But when you just zoom out, one of the problems is we're still fairly bullish on the day, on the daily chart. The bears, they need to start getting a series of bear bars closing on their lows. They have a trend line break. That's good for the bears, but then the retest is pretty strong, and therefore the bears need to do more than what they've done so far. This is not enough. So even if we do get a reversal down, I suspect it's probably going to be mostly minor. And as far as tomorrow goes, the bears, they'll try their best to get some kind of weak follow through on. The bears are hopeful that tomorrow will form a strong bear reversal bar, but even if it does, it's probably not going to go all that far down, with at least going sideways first. So the bears, they're going to need to do more than just this. And on the 5-minute chart, we're gapping up on the open. Strong enough reversal bar, good for the bulls. But the bar is big, and therefore the risk is big. And for a lot of traders don't want to risk 15 points with the first bar of the day. And that will lower the number of traders willing to buy above 1. 2, follow through bar, but body smaller relative to 1. We have a tail on below 1, tail below 2, and a small tail above 2. And that increases the risk that we get some kind of pullback on 3 or 4. And then obviously 3, we got a strong surprise for the bears. Strong enough bar, odds are we'll get at least another leg down. So that's good for the bulls. Good for the bears. Probably sellers on any pullback. And then you can see what happened with 4. 4, the market went up and then reversed down rather sharply. Good for the bears. Consecutive bear bars, 3 and 4, probably will get at least a small second leg down. But I still think that the odds are against the bulls, the bears getting a bear trend after 1 and 2. And therefore, there's probably buyers somewhere below 1 and 2, maybe a measured move below, maybe near the close of yesterday. Bull bar on 5, good for the bulls, but after 3 and 4, probably sellers above. 6, low 1 short, not a good sell. Below 6, it's a breakout pullback sell. Bears hoping for a second leg down below 5. You have some bulls buying above 5, stop below 5, but realistically, I think there's probably buyers below 5, even if we fall below it. And then we did. You can see on 7, we went below 5, and the smart bulls that bought above 5, they bought more below 5. 7 for the bears, second leg down after 3 and 4, probably best for the bears to get out above 7. Too much risk that bulls will buy above it. 8 consecutive bull bars, 7 and 8. Good for the bulls. It's a bad low 2 below the 8 low. Low 1 below 6, low 2 below 8. Assuming we fall below it, it's a bull bar, and therefore probably buyers below. Testing the audio, and looks like it's working for me. And then 9, we have 3 consecutive bull bars with 7, 8, and 9. Good for the bulls. Looks like we're going to go higher. 10, another bull bar, still climbing higher. I suspect at a minimum, we're probably going to reach the 2 close and allow the bulls who bought below the 2 close and more lower to make money. And then we're getting a little bit of weak follow through after 11. And that's a sign that we may end up pulling back soon. But 5 consecutive bull bars, probably buyers on the first reversal down. 12, doji, not a good sell below, so probably buyers below. And then 13, we broke below 12, but that's the first bear bar we've had since the reversal up below 7. And therefore, I suspect more traders buying the close of 13 than selling it. 14, bull bar, you can call it a breakout, pullback buy, so a high one buy. Good for the bulls, probably going at least a little bit higher. 15, testing the 13 close. Bears sell the close of 13, disappointed. 14, getting out, break even. 15, and the bulls know that, so the bulls are buying. Either above the 14 high or buying the close on the retest of 13 during 15. 16, 3 consecutive bull bars, good for the bulls, probably going at least a little bit higher. And then tail, 18 above the high of the day, and a second leg up above 11. Disappointing for the bulls, but realistically, who's going to sell below 17? Really not that great of a sell. It's a pullback bar, and because of that, there might be more traders buying below than selling. 18, breakout, pullback buy, so another high one buy. Even if we pull back for a bar or two, I suspect we're going to go above 17, so really not great. And then 19, bull bar, good for the bulls, trapping the bears who sold above 18. So there's probably buyers near the high of 18 if we retest it. And instead, 19, 20, looks like we're just going straight up. 21, another bull bar, but testing near the July all-time high. Probably going to get there, but we're getting a fairly tight bull channel, so a small pullback bull trend. And then 22, we have another bar added to the rally, but getting prolonged. We now have a 5-bar bull micro channel, and we had a 5-bar bull micro. We had a 6-bar bull micro channel up to bar 12, and now we're getting a 5-bar bull micro channel up to 22. Makes me think that a pullback is most likely. Doji with 23, not a good sell below, and therefore probably buyers below. And then 24, we broke below the 23 low. But who's going to sell the close of 24? Probably nobody. If anything, it's probably more buy the close than sell the close with how tight the bull channel is. 25, bull bar closing on its high. Good for the bulls. Even if we pull back, I suspect we're going to go higher. So you're either long or flat. If you're buying, it's probably better to be willing to scale in lower, just in case the market does end up pulling back. 26, weak bull entry bar, but probably buyers below in a second leg up. And then 27, doji, not ideal for the bears, but also not good for the bulls either. So we may end up getting a tight trading range here. We're right at the all-time high, and we could easily go a little bit above it. Bear bar, 28. It's okay to exit shorts, exit longs below the bar, knowing if you do, the most likely you're going to get a minor reversal and then trend resumption. And then doji on 29, not a good entry bar for the bears selling below 28, but not a good buy for the bulls buying above 29. But it's still a tight trading range above the moving average for a lot of bars. Makes me think that we're still probably going to go higher. 30, bull breakout of the tight trading range, strong enough a bar that the odds are we'll probably get some kind of second leg up, but fairly high in the rally, so we may end up getting a pullback first. What about selling the close of 30? Well, the problem with selling the close of 30 is the target is probably the midpoint of the bar, maybe the bottom third of the bar, and the risk is bigger than 30, and therefore selling the close of 30, even though it seems logical, it's not really all that great of a trade. And that's why I mentioned that 31 probably has more buyers below. I mentioned during 31 that the bulls who bought the 30 close and buy more during 31 will probably make money. And that's what happened. They tried to get out on 32 and the market didn't quite let them out. Let me see, actually. Close of the bar, 53 and a quarter, and then 53 and a quarter. So the market did not let them out. Now we have another second entry, possible wedge. 22, 26, 30, but in a bear bar closing on its low, 32. Good for the bears, but not a great sell. You're so close to the moving average, and you have a lot of traders buying as it's pulling back to the moving average, and that lowers the probability of traders selling below the bar. Bull bar 33, but probably sellers above, and then 34 consecutive bull bars, 33, 34, not a great buy above. We can still go higher, and therefore it's more bullish than bearish. Bears, if they sell below 32, where do they get out? I think it's smart to get out above 33 or above 30. I would not sell below 32 and just scaling higher. 3 consecutive bull bars, 33, 34, 35, probably going at least a little bit higher. And then 36, doji, probably buyers below and at least into the leg up. Bull bar 37, an implied second leg up after the three bull bars, 33, 34, 35. Whenever you get a buy the close rally, and then you get a doji like 36, usually the market will go up for maybe a bar or two, sometimes 3, and then it'll often pull back. So as far as buying right here, really not ideal. And then a bear bar 38, closing on its low, makes me think we'll probably pull back soon, even if we have to go sideways. What's the probability of selling below 38, stop above 38? It's probably 30%. Realistically, it's a tight bull channel, and therefore the best the bears can expect is a trend line break and a retest of the highs and formation of some kind of major trend reversal. And so what that means, most importantly, is if you sell below 33, if you sell below 38, you're probably going to have to hold through a pullback. In other words, if you're hoping for the start of a strong bear trend, you're probably going to get a lot of sideways trading. And if you're lucky, you won't get stopped out, and then the market will collapse. And since that's low probability, it's not ideal selling below 38. Bull bar 39, high one buy, but probably sellers above. But since we're in a bull trend, the high one buys have a greater probability of success. And therefore, we can easily go above 37 high. And you can see what happened. 40, 41 went above 37. So it makes it very difficult for traders to be selling and scaling in higher. What about buying 40, 41? We're pretty late in the bull rally. And I suspect at some point, bears selling high ones above 39 or highs above 37, new highs of the day, they're probably going to make money, which makes me think that gaps are probably going to close. 42, reversal down, good for the bears. I would certainly get out below 42. Makes me think too much risk. We're going to get some kind of second leg down. 43, high one buy, probably sellers above. And then outside down 44, but an implied second leg down from 42. We sold off 42, 43, found sellers above 43 and got a second leg down 44. 44, probably more traders buying than selling, but I'd rather buy at the moving average, and therefore I'm not going to buy the close of 44. 45, bull bar, second entry buy, good for the bulls. It's a second entry in a bull trend, and therefore, really dangerous to be holding short above it. And you can see what happened when we went sideways for several bars. We came near the moving average on below 48, and then we immediately found buyers on 49. 49, strong enough bar. One of the things I always do, I never like to have price near the high. And the reason for that is I don't want to give the illusion that this is the high of the chart. If you trade like this, one of the problems is you'll think to yourself, oh, the market can't go much higher. It's at the top of the screen, and therefore it would break the screen. Kind of a little psychological thing. And therefore, I always try and keep price in the middle as a reminder that we can always go higher. We can always go lower. 49, bull bar, but a possible double top 42, but in a strong enough bar 49, I suspect we're going to get a second leg up, even if we have to pull back first after 49 and test the 48 high. And then 50, bear bar, but a tail below the bar makes me think probably more traders buying the close of 50, and we'll probably get a second leg up. And the bulls that bought the close of 49 will probably make money. And at a minimum, they'll be able to avoid a loss back to the 49 close. 51, high one buy, probably sellers somewhere above, but I suspect we're going to go above 49. 52, bull bar, good for the bulls. We may go a little bit higher, but you're still at the top of a bull channel, and it makes it really difficult to sell. And then we have a doji, 53, doji, 54. And we pretty much just start climbing to the upside. Now, what do you do? 54, 55, 56. And I made the comment that it's either long or flat. I would not be selling when the market is doing that. And because of that, I would not, if I had to pick, I would only be buying or buying pullbacks. I'm not going to sell. And the reason I'd buy or buy pullbacks is the reality is even if you buy above 57, if you're willing to use a wide stop and scale in, odds are pretty high you're going to make money. It's kind of like buying. It's like buying the close of 37 or buying above 41. If you're willing to buy above the bar and scale in, you got a really good shot at making money. Now, most traders would rather just buy the scale in position, but that's reality. So up here, that's my thought. Even though I'm saying, I'd rather buy a pullback. Well, the reality is there's no way I'm going to sell. And therefore, I would, there's just nothing that can make me justify a sell. Maybe 42, but even 42, it's kind of a crummy sell for lack of words. It doesn't make any sense. It's not, I say it doesn't make any sense. There's logical sense to selling below 42, but the reality is it's probably not going to go that far. And therefore, everyone's selling, the smart traders selling below 42, what they understand is it's going to be disappointing. It's not going to lead to all that it's not going to lead to that great of a sell. And therefore, they'll be pretty quick to exit their position. So bad high one buy 57 makes me think we'll probably pull back soon. Bull bar 58, still climbing higher. But like I said, I'd rather buy closer to the moving average. I don't want to buy up here. Bears who sold above 57, making money on the pullback 59, but not a good sell below 59, probably buyers below. And then 60, bear bar. Good for the bears in the sense that it's a weak high one buy above, but I suspect probably going to be mostly sideways. And then 61, 3 consecutive bear bars. Good for the bears, but probably buyers near the moving average. And then 62, we have a doji. It's a bear bar, a low one short, but right at the moving average. Probably more buyers down here than sellers. So really not a good environment for traders to be selling right at the moving average. Makes me think that more likely we're going to be sideways. And then 63, bull bar. Who's going to sell at the moving average? Well, I thought two things right here. So I thought 63, it's a good signal bar for the bulls, and therefore it's a good buy. But one of the problems with 63 is that 63 is a lot of bars up in the type bull channel. And so if you think about that, think about the problem with that. You have, whenever the market spins a long time away from the moving average and it's starting to go sideways near the moving average, there's always the greater risk that it won't go far from the moving average. And when you look at 63, it's giving you an opportunity to buy at the moving average, and that's good for the bulls. But let's see what happens. Is 64 going to be a strong follow-through bar telling us that traders were desperate to buy at the moving average and that the market's going to race higher? Or is 64 going to be a disappointment bar? Is it going to be a doji? Something like 46. Is it going to be a doji warning us that not a lot of traders were desperate to buy? And then look at 64. 64 is a doji that's warning traders that we're not racing to the moving average. Like here, this is a good example. We have a bull bar closing on its high, and then price immediately goes higher. It was the second attempt at touching the moving average. And then we get another bull bar. So it's trapping the bears who sold and scaled in. Not quite the same here. Another doji, 65, makes me think that we may form a tight trading range for a lot of bars. But the one thing I think is for certain, the odds are we're going to fall below the moving average. 66, bear bar at the moving average. Good for the bears. Probably going to go sideways though. So really, for me, I'm not going to sell at the moving average, but I think we're going to fall under the moving average. Bull bar, that's at 66. Bull bar 67, second entry buy. Probably, if you're short, I think you definitely get out of shorts above 67. It's an okay buy above, but chances are it's probably going to go mostly sideways. Why is it an okay buy? Because I think the odds are we're going to get a close below the moving average. And because of that, I'm pretty resistant to buying until I see a close below the moving average. And then 68, we have a decent, it's an okay follow through bar, but inside of a tight trading range. There's your tight trading range. And then we got a bear. We tried to break to the downside, 69, allowing the bears who sold to close 68 out. So it's a small implied second leg down after 66. not a good sell. 69s are probably going to bounce, and you can see what happened. We just rallied up to 2 ticks above the high of the day and sold off 75. And that was the minimum expectation to close below the moving average. But you can see what happened. Even though we closed below the moving average, we still went higher. So anybody that bought, pick any spot, you buy the high tick of 59, as long as you don't panic out of your longs and you trade small enough and you scale in lower, you're going to be fine. And that's what traders understand about small pullback bull trends. They're not my favorite kind of day. They're great if you're a swing trader. If you're willing to just, you buy above the 7 high and you just keep adding on. Every time you get a bull bar closing on its high, you buy above 7, you buy above 9. You wait for the pullback, you buy above 14, you buy above 16. You wait for the pull, maybe you don't buy there because it's the same price, but then you buy more above 25. Then you get a couple bars up, you buy more here, and then maybe you buy more there. But the reality is, if you're willing to just buy, and remember what I said about always in, let's just talk about always in for a second. For the always in traders, if you're long on 2, I don't think it's great because 80% of the time you get a reversal, at least minor. 50% of the time you get a major reversal. And, I forget to say it a lot, but I'll try and make a note to remind traders about it. But 80% of the time on the open, you get either a double top or a double bottom or a wedge top and a wedge bottom, which means 80% of the opens, 8 out of 10 opens you see, you're probably going to get some kind of double top, double bottom, wedge top, wedge bottom. 20% of the time, you're going to get some kind of trend from the open. And therefore, when you see bar 1, it's about a 20% chance, give or take, that it will lead to the low of the day. And so whenever I see, if you're buying, let's say you buy above 2, which it didn't trigger in this case, but if you did, and you see 3 racing down, I think it's okay to get out of longs. If you sell below 3, you can get out above 5. That's reasonable. Otherwise, I'd get out. I'd certainly get out above 7. And then bears, if I got out above 5, I'm not selling below 6. Bulls, they can buy above 7. And then where do the bulls have to get out? I don't think they have to get out anywhere. It's really none of these. These are all minor reversals. 20, maybe 30% chance they lead to a successful major trend reversal. So bulls don't have to get out anywhere. So for stop entries, I made the comment. I kind of already talked about that. Buying, you can buy above here, you can buy above 1, but you probably get out below 3. You can sell below 3, betting on a minor reversal in the second leg down, but I'd get out above. I think it's okay to get out above 5. Selling below 3 is really not great anyway. So getting out above 5 is okay. I think you definitely get out above 7 if you're a bear. And then bulls, if they bought above 1, they got stopped out below 3. And this is kind of where life can be frustrating, and you gotta think about how you're willing to trade. Buying above, when you buy above 5, you have a couple of choices. You can buy above 5 and then get stopped out below 5 and then buy again above 7. But a lot of traders in that situation, if they're buying above 5 and they think there might be a small second leg down, a lot of times what they'll do is they'll do one of 2 things. They'll use a wide stop, maybe a measured move based on the range of 5, or they'll trade a half size position. So instead of a normal size, if they trade, let's say they trade an Emini, they'll trade 5 micros and buy above 5. And then if they get stopped out below 5, they'll buy 10 micros above 10 or above 7. So they'll basically double their position. Most traders shouldn't do that. It can be, I think it's easy for it to be complicated, but that's a logical thing. I think most traders, for me, if I was going to pick between the wide stop or doubling the position, I'm probably just going to use a wide stop. But overall, bulls, they can buy above 5 or buy above 7. And then, any bull bar closing on its high is an okay stop entry buy as long as you're willing to scale in lower. Bulls, they can get out below 42, but they probably buy again somewhere, but not easy. Even buying above 49 is not that easy of a buy. And if they buy above 49, I think they can get out below 59. That's probably okay. And then through here, I'm not going to do anything. I want to see it close below the moving average. And by this point, it's too late in the day to want to do anything. I don't give these days a lot of thought. They're fun to see, but the reality is I never get upset about missing a move. And you shouldn't either. The reality is this is a small pullback bull trend day. It's a low probability day. And there's nothing wrong with folding your arms. After you see several buy climaxes on the way up, traders become less inclined to wanting to buy. Limit orders, I thought buyers below 1 scaling and lower, buyers below 4 better because we had 1, 2 legs down with 3 and 4. I thought buyers below 12, I thought buyers below 17, buyers below 23, but better to buy a deeper pullback. And then I thought really, only look to buy a pullback. You can buy below 45, you can buy below 47, buy below 48. I thought sellers above, but really dangerous for most traders. And then you can buy at the moving average if you're willing to. And it's basically just limit order buys below everything. Buy the close, sell the close. You can argue buy the close too, but tough call. You're buying a fairly big gap up with relatively big bars above the range of yesterday, so above yesterday's high, not ideal. And then you can buy the close 8, 9, 10, 11, or buy the pullback. You can buy any of these closes or buy the pullback. And then all through here, it's really more buy pullbacks than closes. So when you see a bear bar 50, you buy the close. Most of the time, the market's in a channel, and therefore, instead of buying the breakout, it's usually better to buy the pullback. Okay, let me take a look at some questions. Okay, well, question, were there any signs that you noticed that indicated buying above 2 was a trap? Yeah, a couple of things. One, whenever you get a gap up and you have a relatively big bar on 1 and then a small bar on 2, and the bars are relatively bigger than the prior day's bars, it's forcing you to enter on a deep pullback. Think about what you're doing. You're buying a breakout from 81 to R2, and therefore it could easily test all the way down here. The other thing, sometimes I'll cheat and I'll look at, say, like a 15-minute chart, and you can see what happened. So look right here. We had a bull, we had a report bar. Let me just do it like this, because it's easier for everyone to see. So we had this report bar here, and then we have the open of the day was 835, this bar right here. So we had a bull trend line break, retesting the highs, and therefore we're already into resistance from the report bar around 730. And that actually increased the risk that we'd get a pullback after above bar 1. So whenever, if I'm going to trade the first few bars of the day, I really like to pay attention to the Globex, just because it's got the most accurate information on the chart. It's the most relevant or the newest information. But you don't have to look at Globex. Generally speaking, my rule of thumb, I say it all the time, most traders should wait for at least 6 to 12 bars. So if you waited for 6 bars today, look where you were. You have a breakout pullback sell, so a low 1 short after a decent bull bar here and consecutive bull bars here. You're probably more likely in a buy zone than a sell zone. And therefore, you don't have to buy below a bear bar closing on its low. But when you get the reversal up on 7, you know that you have trapped bulls. You bought the close of 2, and now they have a second entry buy 7. You can buy above 7, stop below 7, and think about it. 1 times your risk. That's 1 times your risk. So you could buy and set a stop for twice your initial risk up here, or you can buy above, and then when you see the market start to go your way, you think to yourself, wow, my actual risk was basically 1 tick below the low of 8 if I bought above 7. And therefore, if I set a target up here, I'm going to make many times my actual risk. Do you ever trade after bar 72? Sometimes I will, but generally it's not really my favorite time to trade. Okay, question. It's kind of a vague question, but can you talk about signals and where they are positioned? For example, when they're too high in the range, what are the nuances that a beginner has not thought about? Well, yeah, so basically what you're asking is, can you talk about signal bars in relation to context? And this is actually kind of it's a good segue into what I plan to convey in Orlando. If you think about Al's video course, he talks about context and he talks about signal bars. And if you think about let's take the order of the Brooks trading course. You have the fundamentals, you have the getting started, you have the fundamentals, and if memory serves me right, it goes straight into thinking about the market cycle. So what is the market cycle? And then you have trends, and then you have channels, you have micro channels, you have tight channels, broad channels, you have trading ranges. And so if we think about a signal bar is not as important as what is the market cycle. Let's look at this chart. This is a line chart. There's 0 signal bars on this chart. What does this tell us? Strong breakout, 2 legs down, and then we get a reversal up. So we're getting a breakout, pullback, buy setup. So if you buy in here, odds are, it's reasonable to assume the bulls who bought here and bought more lower will make money, and therefore will probably test back up to this area. Very reasonable to assume. When I see a type bull channel, when I see a rally here that's parallel to the moving average, what should I assume? I should assume that we're probably going to go sideways to up, and therefore I can buy. How do we relate that? So this is the market cycle. We know we're in a bull channel. Now, how do we relate that to candlesticks or signal bars? Well, a couple of things. One, if you understand bars and pivot, in other words, if you understand how many bars on average are in a micro channel, it's not many. It's usually not more than 5, 6 bars. That's a fairly low probability event anyway. And usually the market pulls back after that. You'll typically look to enter on pullbacks. Then the other thing is just look at these bars. Most time when you get a bull bar closing on its high, it goes sideways a few bars later. Here, you have a bull bar closing on its high, but it's a breakout, pullback, buy setup early in a rally. And then up here, you get bull bars closing on their highs, but it's forcing you to buy higher in the range, and we go sideways. So what's the point? The point is, in channels, if you can identify the markets in a channel, it's usually better to wait for a failure attempt, such as a reversal, and then look to fade the reversal. Don't buy the close of 21, 22. Wait for 24 to reverse and buy as 24 is going down or as 24 starts to turn up. But overall, the nuances of signal bars, the more it's trending, the more traders will just buy above anything, and they don't really care about the signal bar. The more you are trading counter trend, the more you care about a signal bar. So if I'm going to sell, I need it to be really good. I'm not just going to sell below a doji 23. I need a strong signal bar. 42, it's a good signal bar, but the context isn't great. It's a type bull channel, and therefore if I'm selling, 42 is okay. It's better than all the others. 32, not a good sell signal bar. It's an inside bar with 31 inside of a tight trading range. So really not ideal. And then if it's in a trading range, I care more about buying low and selling high and how many legs down you have. Look over here. This is a bear channel. Why wasn't 64 a good buy? Well, it's following a surprise 63. So if you buy above 64, that's one push up. Then we pause on 65. Then we got a second leg up, 66. Pause 67, 68. Then we got a third push up, 69. But what did 69 do? It's a truncated wedge. 1, 2, and then we formed a lower high. So it's basically an implied lower high major trend reversal on a smaller time frame. Bear trend, so we have a bull trend with bar 64 on like a 1 minute chart, or really less than that. We have a higher high major trend reversal, and then we have a lower high major trend reversal. So to me, 69 is a credible sell because we're already in a bear trend and the bulls have had 3 pushes up. Here, if I'm selling 39, I'll sell below 41. I don't really care because it's a strong breakout 39, and therefore I'm expecting a second leg down. And that's why these sell signal bars don't look great, because the odds favor lower prices. Okay, let me take a look at some more questions. Okay, question. I bought above 7. Okay, that's a good buy. So they bought above 7 as the market was moving in my favor. I was thinking of bringing my stop to break even, but didn't know when. I got twice my risk, but still want to know when the time was right. Yeah, I don't know. For me personally, if the market starts to go my way like this, I'm probably going to tighten my stop to break even, just for the simple fact that, for me, I generally have a scalping mentality and I want to protect what I made. Now, it's really a flaw. If you really think about it from a math standpoint, it doesn't make any sense because you're still losing. Your entry price is not, your risk is not your entry price to your stop. It's the market price to your stop. And therefore, if you buy above 7 and you're long up here, your risk is is where the market is to your stop, which is the high of 7. It's not break even. But overall, for me, I try to think about it more from the standpoint of, what's my overall goal on the trade? In a situation like this, I might be willing to buy more on a pullback, betting on a test of the 2 close, because that's a reasonable trade. But as far as simply buying above 7 and then seeing I don't know if you're talking about initial risk or actual risk, but overall, I'm assuming that you're talking about initial risk. And so if you buy above 7, stop below 7, and your initial risk is somewhere up here, I'm certainly not going to use a break even stop at 21. So if we're up here, I'm not going to keep a stop down here. I'm going to put a stop, maybe below 18 or 19. So I say, I might use a break even stop quickly once I start to get a series of bull bars. But realistically, I'm just going to put a stop, somewhere down here, because I don't want the market to pull back there in the first place. And then when we start to go higher here, I'm going to put a stop down here because I don't want the market to fall below the most recent swing point. So I hope that makes sense. So as far as tomorrow goes, we have a decent bull bar on the daily chart. It'll be interesting to see. Can the bulls get a strong follow-through bar? Or instead, will the bulls get some kind of disappointment bar? I suspect that the bulls are going to get some kind of disappointment bar on the day, but we'll see. All right. Thanks, everybody, for listening. I hope everyone has a great rest of their day.